Hi friends, I am Hiren Chandaria from Reliance Mutual Fund. I'll be talking about gold and giving a presentation on gold ETF. As we all know, the fascination of gold in India is unmatched. Gold use is imbibed in our culture, tradition, and religion. There is absolutely no substitute for gold, and I believe there will never be. The use of gold cannot be done away with. Before we start with formal presentation, let me throw some interesting statistics. Many of us believe that gold price run-up has started only recently, at the most a decade ago. But let me burst this myth and surprise you with some numbers. The annualized return for gold over last 40 years for Indian investors has been above 14%. Yes, my friend, I'm talking about 14% plus CAGR. The performance is equally good for a period of 5, 10, 15, 20 and 30 years. You may be wondering, why did we take a period of only 40 years? The reason is that before 40 years, most of the currencies were backed by gold, and that is why we did not have a free float market for gold prices. Now let's go to slide number 7. The total gold mined till date is around $9.7 trillion. Out of that, around 9 trillion worth of gold is available for investment. That is, if all the people holding gold in terms of bars, coins and ETFs decide to sell their gold. Now let's examine why did we take only 1.9 trillion worth of gold available for investment. The logic is pretty simple. Gold lying in jewelry is unlikely to hit the investment market. If you don't trust me, ask your better half to sell her gold jewelry and invest the proceeds in investments. It's very unlikely. Similarly, gold used in industry is unlikely to hit the investment market. So I would say only 1.9 trillion worth of gold is available for investment. The only other sector left is the official sector, which we'll discuss later on during the presentation. Now on the supply side, no new major discoveries have taken place over last couple of years. The annual supply is to the tune of 2,500 to 2,750 odd tons, and that's unlikely to change over the near future. This increases the gold bar availability by around 1.6% annually. And it is also important to note that most of the gold ore grades are depleting and the cost of mining is going up. So in a nutshell, if the demand is increasing by more than 1.6%, the demand supply dynamics are favoring higher gold prices. As you can see in the next slide, gold has given positive returns and made a new high every year since 2001. Again in next slide, you will see gold has been an absolute performer during various time frames. This slide shows that gold's correlation with other asset classes is not statistically significant. Any correlation which is less than 60-70% is not statistically significant. The reason is the factors that affect gold prices do not affect other asset classes in a similar fashion, and that is the reason gold acts as an excellent portfolio diversifier. For example, any particular event like higher crude oil prices, geopolitical unrest, or rupee depreciation would have a different impact on gold than it has on other asset classes. Turning to slide 12, now let's look at what would have happened if we would have invested on this auspicious day of Dhanteras over last 10 years. At every juncture, we would have positive returns, and most of the time the return would have been above 15%. We have already seen demand-supply dynamics favor higher gold prices. Now let's try to address one of the most prominent questions. How can gold prices go up if Indian demand is not that strong? Currently, gold prices are trading above 30,000 rupees per 10 grams, and that is very high price according to Indian investors. The demand is very weak and people have been refraining from buying gold. From an Indian paradigm, yes, Indian demand is weak. But let's look at the global context. Gold is a global commodity and cannot be looked at only from the Indian paradigm. Few years down the lane, India was a clear dominant player and used to be the world's largest importer. China was nowhere near the site. But today, China is challenging India's dominance and is likely to surpass India as the world's biggest consumer of gold. And we are also seeing very good buying interest emerging from countries like Turkey, Taiwan, Russia, and China. So we need to look at it from a global perspective. Supply is not increasing, but new demand is coming up from various new players. The intensity of gold consumption in countries like India, China, Russia, Indonesia is very low when compared to advanced nations like US, UK and Japan. This may indicate that when the GDP increases, the propensity to consume more gold also increases. Coming back to India, the price-sensitive Indian investors do help in capping the downside for gold prices. Indian investors do refrain from buying gold when the prices are high, and they spawn into action and make up for the lost opportunity when the prices drop down, thereby increasing the demand and the prices. Next slide talks about sovereign debt crisis and US fiscal cliff. Situation in Europe continues to deteriorate despite numerous bailouts. If bailouts have not been able to help so far, I wonder what will new bailouts do. And that is why I am pessimist on the outlook of euro as a nation. The fiscal cliff in US is a catch-22 situation. If the tax incentives are extended, then they would distort the debt and deficit dynamics, and if they are not extended, then they would hurt the economy. Either ways, it is positive for gold as gold is seen as an alternative asset. In the next slide, we would be focusing on deteriorating financial and economic conditions. The growth momentum is deteriorating. During the last crisis, China was instrumental in bailing out the world economy. However, currently, China is struggling to maintain its own growth momentum. Again, it is believed that even if growth momentum comes back, it's very unlikely we would see a re-acceleration in the economy. Such fear psychosis is very positive for gold prices. Many countries with high forex reserves have less than 2% of their reserves parked in gold, and that does not compare well with Western economies who have more than 55% of their reserves parked in gold. Central banks have increased their gold reserves. The gold purchased by central banks during June 2012 quarter has been to the tune of 158 tons. That is a 140% increase over the same quarter last year. If China alone wants to increase its reserves to 10%, then they would eat away around 2 years of mine supply. Central banks need to buy gold to safeguard against falling currency value and currency volatility. And that is why I believe that central banks would continue to buy gold over the foreseeable future, and that would be very bullish for gold prices. Given the current macroeconomic environment, there are two probable outcomes. One is we will have good growth with good inflation, and the other is we might not have growth or inflation. In either of these two situations, gold tends to benefit. After the positive outlook of gold, let's try to find out which is the best way of investing in gold. In my opinion, gold ETFs are the best way of investing in gold. No wonder the all known gold ETF around the world hold around 83 million ounces of gold. And our star share gold ETF has an AUM of less than 3,000 crores. Gold ETFs are investor friendly. The units are held in demat account where you don't need to worry about safety and security. The units are held in the demat account and one can easily buy and sell anytime during the NSE or BSE trading hours. The markets are very transparent. You can see the bid-ask spread. You can buy and sell at any time during the prevailing market rates, and you can buy as little as one unit. Not only it is easy to invest in gold ETF, but it is also tax effective. The long-term capital gain tax advantage is applicable just after 1 year, whereas if you hold physical gold, the long-term capital gain advantage is applicable after 3 years. So here the benefit is only after 1 year, and there is no wealth tax. I am pleased to inform you that Reliance Mutual Fund has rebranded ETFs as R Star Share. Reliance Gold ETF is now branded as R Star Share Gold ETF. Thank you, my friends, for listening in. Happy Diwali and Happy Dussehra. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.